Good afternoon. Welcome to today's session. My name is Annastacia. Today, I'll be presenting a case study on portfolio optimization, and I'll be focusing on how different assumptions about asset returns, risks, and correlations can dramatically change the allocations we get from mean variance analysis. We will use three assets, and the assets are the SP 500, MSC World, and Lehman Brothers for this case. And we will see how the results will shift depending on different adjustments that we'll make as was required by the assignment. Then beyond the numbers, we will go ahead to see how important its lessons can be about risk management and what goes wrong in the event that there is a financial crisis. So maybe I can share my screen and start on the first question of the assignment. So we will start with, we will go straight and I will share first is the question. So let's start with the questions. So there was the first question of the assignment. So the assignment was to assess. I am assuming that now I am the advisor. So question one was using the return data for IBM in Exhibit 1, calculate the mean and variance for standard deviation for the stock. So we go ahead and view this. So this was the data that we had been given. This was the monthly return data that had been given for this assignment. So question one, we calculated the mean. So mean is basically the average for the IBM. As per the question, IBM is the current portfolio of the client who seeks to be advised. So it's basically the average of the monthly stock data. And then for IBM, we need to do the standard deviation, which is here. And then on top of that, we did some annualization using a formula that's where we add C3, which is the IBM, that is the average, plus 1 raised to power 12 minus 1. And then we also annualize the standard deviation. This would come in handy later in the assignment. So we continue, sorry about this. So we continue with the work. So on top of that, we went ahead to look at question 2. So from this, the second question was, we need to assume a portfolio with 3 equally weighted asset classes using the return data in Exhibit 1, calculate the monthly return portfolios. So, and from these returns, we were required to calculate the mean and standard deviation of the portfolio. And there was a question, what arguments could be made for the client to sell IBM and diversify into such a portfolio, and what arguments could be made against it. So we did, if we are assuming equal weights, we had 3 stocks, and so equal weights would be 1 divided by 3, so the weights will be a third for each. And from this, if we use the formulas provided, we get first the average of the 3, and then to get the portfolio, the standard deviation, we do the same. So I think this was the average for the 3 of them. Let me just maybe go ahead a bit and get, so we first did the individual, and instead of just multiplying each one times 3 and their third is a common factor, we just add the 3 of them to get the portfolio monthly return. That is the return for every month for the 3 portfolios. So we should take each return and multiply it by the weight. But in this case, since the weight is the same, we just take it and we add the monthly returns. in a different case, we would have taken every separate weight, multiplied it by the monthly return to get the portfolio return. And then if we to get the monthly returns, but then if we want now to get the average, we get the average of the monthly returns. That is the portfolio return over the whole duration during which this historical data was provided. So we get the average. And then we also go ahead to get the standard deviation. And that answered our question 2. So we proceed to look at question 3. So for question 3, for question 3, we were supposed to be looking at, sorry, there is something I did not go into. So there was some reasons for arguments for selling IBM and for not selling IBM. So IBM is what we've just calculated in their first question. So arguments for selling IBM would be that there is a diversification lowers the risk, and then you also get more stable returns. And then if you go through the way of selling, you eliminate company specific risks, that is risks just associated with like one particular company. And then better risk, and you also get like better performance since the risk has been adjusted. As such, we're saying that there is also arguments, before I summarize, arguments against selling IBM was that IBM had a higher average return, as you can see. It had a higher average return as opposed to what we just obtained for the 3, which is 0.67. And then the other reason against selling IBM would be the loss of upside potential. There is potential in maybe if the stocks in IBM specifically just decide to grow, then at times, because of the weighting, the fact that there is weighted returns, diversification tends to dilute the strong performance in a portfolio. So let's say one portfolio is performing like really well and others are performing not at 0, but maybe they are performing averagely, maybe at 20, then the best performer, unless otherwise, is forced to pull up the other stocks that are not performing too well. And then the other reason would be that possible, there is also the fact that now you're doing like 3 stocks. This comes with possible transaction cost and possible more taxes as opposed to managing just one. And as you can see, even for this example, for 3 stocks, if you want to invest in that, you may maybe need someone to analyze that for you. And that is where the extra costs come in. So, sorry. We proceed and conclude that portfolio optimization is built on 2 simple but powerful formulas. The expected portfolio return is just the weighted average of the returns of each asset. The portfolio risk and standard deviation is basically the square roots of the weighted sum of each asset variance plus the covariance between every pair of assets. And this, in other words, it's majorly the risk. And risk not only depends on the volatility of each asset individually, but it also depends on how the assets move together. And that's why we are saying, in some cases, as an argument against selling IBM, that correlation is a factor. How are these assets moving against each other? And hence, that strong performance may get diluted in the process of diversification. So correlation is critical because it will tell us whether if we combine these assets, are we amplifying the risk or we are trying to reduce the risk? So moving forward, question 3. So for question 3, we were told use the mean variance optimizer in Exhibit 2 to calculate the weights in the 3 asset classes, domestic equity as proxied by the SP and 500, International Equity proxied by MSC, I, World Index, and US Fixed Income proxied by Lehman Brothers. So for the optimal portfolio, when the target standard deviation is 10%, in this exercise, the optimal portfolio is the portfolio with the maximum return. So we are supposed to calculate using the weights for this optimal portfolio. So that's what we are seeking to see. So this means we are not now just working blindly, but we have a target. So this was the optimizer in Exhibit 2. We were downloading this from the requirement in the text, and from this optimizer, we set the target at 10. So what did this mean? This meant we are going to solver. So this is my solver. This is solver. And we were supposed to set a cell to optimize. So in my case, maybe when you see my solver keeps on changing, I'm sorry. But in my case, the cell I was optimizing was the average return, which is cell E3 typically. And I have put in variables for it. So there is the first variable. So the variable should be that my standard deviation, the annualized standard deviation, this one must be equal to the target that I'm setting, which is 10%. Then I would set constraints that the weights that I have should be equal to 100. We are not doing for the weights, we cannot take negative values because we're looking at optimizing the returns. And that means they need to be greater than 0 and they need to add up to 1. And the most important one, that the annual standard deviation after the new weights that we hope solver will optimize, then it should be 10%. So we did the optimization and we obtained values 56.91 and 43.09. So we were also supposed to go next and do the next question, which was, and the reason as to why we have chosen those as the constraints, there was a restriction. We were assuming typically that as an advisor, I only have control over the weights in each of the asset classes. And in order to optimize, I needed to know the parameters that can change. And there were a few constants, and the constants assumed for the model are the returns. Those ones are the ones in the optimizer already, the standard deviations and correlations of the asset classes in the optimization. So we were assuming that they are constant and the advisor does not have the power to change that. And it makes sense even in real world because you cannot change as an advisor the risk that a stock bears. You cannot change as an advisor the variations the market can take. So we proceed to question 4. So question 4 was about repeating the exercise in question 3, and while repeating the questions in exercise 3, what were we supposed to do? We were supposed to adjust the target standard deviations to 2%, 6%, 14%, and 20%. And we are supposed to see what is feasible, what is not feasible. And in the process, we're supposed to see what can be done and what cannot be done. So in this case, we adjusted these targets to 2%. And at 2%, it was not feasible. It did not adhere to the conditions. At 6%, it was very feasible. And at 14%, it was also feasible. And at 20%, it was not. The standard deviation for me, Solver kept on saying that it cannot meet it cannot meet the requirement or it's not able to find a feasible solution. So a few takeaways here and a few answers. So as stated in each trial, not all portfolios are feasible. So what adjustments and strategies can we do? First, there is adding cash or money market instruments to allow the optimizer to hit ultra low risk targets because cash has near zero volatility. Then these will pull the frontier we obtained closer to the origin, lowering both risk and return. At the other hand, it could also be including higher volatility assets such as emerging market equities, commodities, and alternatives such as hedge funds, private equity, and real estate. These expand the frontier upwards, enabling portfolios with 20% plus risk and higher returns because as we saw at 20%, it is not feasible. Then we can also do something like derivatives. Um, we can also add instruments like derivatives and hedging strategies, which can also reshape the frontier by reducing the downside risk while keeping equity exposure high. The impact of these additions is that the efficient frontier will shift outward for any given level of risk, and then expected return might improve when we make such additions and such adjustments for any given level of return, and risk can be reduced. However, once you broaden the asset set, you should also impose additional constraints to keep the optimization realistic. So this could also mean, besides just setting the standard deviation as equal to a certain target, it could also mean that we may need to include weight limits, like, for example, that no more than 50% allocation in any single class. For example, the one that we are having 56, we can say that besides just our weights being more than 0 and totaling to 1, then any particular weight cannot be above 50. So that means in your portfolio, allocations will fall below 50 to accommodate, and this could maybe mean that most of every portfolio, if there are 3, must be included in the work. Then that would also mean that we have minimum allocations to bond or cash for liquidity restrictions or illiquid alternatives and policy rules such as ESG screens. Without such constraints, solver may not be able to get optimal solutions. So the other question was, we were also supposed to do a graph, which we did, or I did. So this was a graph. I couldn't plot 2% because it was not feasible. I couldn't also plot 20%. And IBM was an outlier on its own at this point. So that's why it looks disconnected. Then there was the last question. There was question 6. So question 6, I was supposed to replace some of the correlations, and I was also supposed to lower the expected returns at given points and also assign a target of 10. So at this point, I did that. And on doing that, I gained different results. Excuse me. I gained different results on doing the adjustments at 10%, and this was it. So there was the adjustments. I went doing the adjustments, and this was the working. I got some models that were feasible and some that were not. So, and then I also repeated this. That was question 10 and question 6. So basically question 6 and question 7 were supposed to make you adjust based on different standards. And on doing that, the frontier kept on shifting, and it meant that for different allocations, we need to do different adjustments. And that was what was happening for question 6 and portion 10. Thank you.